Hello, everyone. Welcome and thank you for being here this afternoon. My name is Trace George. I'm the events coordinator here at Plan, and I am pleased to introduce Megan Dowd, our director of product insurance here at Plan. She has four specific designations, each related to specialized knowledge in different areas of insurance and wealth management. What we're talking about here today is really important, especially as it relates to how various life milestones influence your client's insurance needs. By recognizing these moments, you can help clients make informed decisions and ensure their insurance plans align with their evolving circumstances. Before we dive in, yes, this webinar will be recorded. Yes, the slides will be sent out afterwards. And please direct any questions into the Q&A, and we will do our best to answer them as we go. And from here, I'd love to hand it over to you, Megan.
Thank you, Tracy. Appreciate
Yes.
everyone for joining this afternoon. As Tracy mentioned, we're going to talk through some key life milestones regarding to your client's personal insurance needs. So as you'll see, whether that's graduating college, having children, turned 16, maybe starting into adulthood and understanding some of those challenges that come there, and then even our seniors that we will talk through and kind of some of the considerations they may have. So my name is Megan. I was in the insurance industry for 16 years before I joined Plan as an insurance broker. I also recently wrote a book called Protecting Your Lifestyle, helping you make effective and empowered decisions when it comes to you and your client's insurance needs. So a lot of what we talk about here is also in my book. Education is the thing I am most passionate about when it comes to personal insurance and just helping everyone understand the importance of personal insurance and how it can help planning and make sure that individuals can live the life that they desire. And then lastly, when I do have some time off, I love spending it with my family. We do ride horses and I do enjoy reading as well. So when we talk through key milestones, we're going to hit on a few different ones today. We'll talk through, graduating college, getting married, children drivers, pre-retirees. And unlike health insurance where there's, a little bit more of a definitive answer of like at 26 kids have to move off health insurance or at this age you can start doing this. Personal insurance is really dependent on a lifestyle and what and how people are living life and what they're going to do and how that affects their needs. So we're going to use three client examples today just to kind of help frame the story when we talk through these milestones. So first we'll talk through Neil Normal. He's a single 25-year-old, just recently graduated college. We're going to discuss kind of his decisions that he has to make as he enters the world of adulthood. We'll then talk through the Smith family. The Smith family you've been working with as an advisor for a while. 20 years plus. So you started working with them when they were just getting married. Now they're going through some life transitions. They have two kids, and we'll use the Smiths again as that example to talk through some of the life changes that will be happening for them. And then lastly, we have Stephen and Sarah Shield, 75-year-olds living off their retirement. They do enjoy hosting charity events and again, talk through some life choices that they'll make when it comes to their personal insurance needs. So, when it comes to graduating college, like I mentioned before, a lot of what triggers milestones in personal insurance comes along with questions and kind of the answers to those questions. So, the first one for Neil is, where are they going to live once they leave college? Are they going back to their parents' home or are they going to start out on their own, renting an apartment, again, living in a new city? And depending on that answer, will determine what their needs are. So, if a child is going back to live with their parents, there's not much that needs to change from the graduating student's perspective. But the parents who are taking their child back into their home may want to consider additional liability concerns, maybe if their child's going to run like a small business out of their home, whether that's a landscaping business or maybe they're going to do day trading, a lot can happen within that home when the college student moves back that those parents may just want to be aware of and understand if there's any limitations in a home policy. On the other hand, maybe this individual is going to move out. Once an individual graduates college, that is somewhat of a line in the sand on when the definition of a covered household member changes from an insurance policy perspective. So once Neil has now graduated high or college, instead of his parents' liability covering him as he goes to move to Chicago, he's going to need to obtain his own renter's policy because he's no longer a household member. He's not in school anymore. So again, kind of takes him out of his parents' responsibility and really puts that onus on him to get the right protection. So again, if they're going out on their own, a renter's policy at a very minimum is what they should obtain to help protect the little personal property they may have, but most importantly, that personal liability that they do carry just by, again, renting an apartment or even sharing a space with another individual. The next question that tends to come along with people graduating college is, are they going to own a vehicle? And again, who actually owns the vehicle is the next question. But if they are going to own a vehicle, and again, moving back in with mom and dad, not a bunch of changes that need to occur. Mom and dad may want to make some changes to the vehicle title just to help with like a liability perspective and not being on the hook if that child is in a really bad car accident. And again, insurance limits are exhausted and based on the title of that vehicle, it's somehow getting back to the parents that are potentially responsible. But then we also have the situation where, again, in Neil's case, he's moving to Chicago. He's not going to take a car with him, but he does have some concerns because he's going to ride a bike to and from work every day. And what happens if he's riding his bike and, someone goes to open a taxi door or an Uber door and hits him in that process? Does he have coverage? Does the taxi company cover him? There's a lot of things that can still arise that auto insurance can provide a peace of mind and protection to, even when you don't own a vehicle. And a lot of times that's known as non owned auto insurance. And again, that's where you can buy up some uninsured motorist coverage for those instances when you are a pedestrian or riding a bike and you're hit by an individual that maybe has no insurance or not enough insurance to cover medical bills. So, regardless on if a college graduate's going to have a vehicle or not, there's still some auto considerations that need to occur. And then next, what assets do they really have to protect? In Neil's situation, he was going to be an engineer, so he does have quite a bit of debt that's currently on his balance sheet, but he also has a really the ability to have a large income in the future. And so when it comes to graduating college, we're really not only looking at what they have today, but what are we looking to protect in the future? And so again, that future income is something to where if Neil got in a really bad car accident and maybe they were going to garnish his wages because he didn't have enough auto coverage to pay those medical bills. As he starts to progress in his career and starts to make more money, he could see those garnishments become larger based on percentages. So, again, it's not only about protecting what college graduates have today, but what they may have in the future. And then lastly, what kind of liabilities do they face? Hopefully most college kids go, get out of college, get the job they want, but in all reality, that may not be the case. So they may have some unique liabilities, such as a second job. And maybe that second job is Ubering, to where there's some considerations around their auto policy and gaps that need to be filled because not all auto policies are comfortable with individuals driving for Uber or Lyft or those type of companies. Or maybe he's going to do some animal sitting, living in Chicago. Maybe he's going to help walk dogs, have animals stay at his apartment while their owners travel. Again, there's some considerations that come in with how he's going to start generating money in the meantime before starting his new career. So, just lots of different things can happen when someone's graduating college that affect their needs and the conversations they should be having around their personal insurance. And as you can see with Neil, depending on how we answer each one of these questions is going to provide different recommendations or considerations for him in the future. And then next, we're going to go to our next family, and they are the ones that are now getting married. So they've met when they were 22 years old. We'll put an easy number on it. Each of them owned their own home, and now they're going to be consolidating as they move in and start their life together. So the first thing we have to consider is property consideration. So if they each own their own home, what happens? Are they selling those homes? And if they're not going to sell a home, maybe they're going to rent it out. And for this example, we're going to use that they're going to rent out the home. So again, they will move their personal property into one home. They'll keep that rent or homeowner's policy for their primary residence, but they will need to make changes on that other property to turn it into a landlord type property coverage in order to get the right protection, not only for the home, but they don't need as much or personal property because they've moved it all to their primary residence. They do though need to consider loss of use coverage for the rent that they will be collecting once they have a tenant in there. And then they may want to consider the deed. So maybe it's currently just in the wife's name, or just in the husband's name, and how they want to move forward with that, which comes into our lifestyle consideration. So I am going to jump to point number 4 real quick here, because that's where we start maybe talking about trust. And do we want to put both homes in a trust? Do we maybe put the rental property in an LLC and the primary home in the trust? And how you deed properties is very important to an insurance policy, because the name on the deed needs to match the named insured. And if it does not, there's a lot of issues that can arise at time of a loss. And sometimes that's a loss not being covered. So again, as we start to consolidate properties, coverages, it's important that the named insureds and the names on the deeds align that entire time. We also have vehicle consideration. So, again, once you get married or even in that engagement process, it does make sense sometimes to combine your auto policy. So, instead of having two separate auto policies, you're going to, either move the wife to one or the husband to one and combine them. This not only gives discounts for your clients, so they'll see multi car discounts, multi driver discounts, but again, they can tend to bundle it with the home that they now have together. And we want to make sure that there's not kind of extra or double coverages that you're paying for by keeping those policies separate. So I do think when it comes to vehicles, combining them does make sense. It is important, though, to keep in mind that if one of the individuals has a bad driving record, that will impact the entire policy. So maybe he's got a few speeding tickets on his account. If we go to add him to her policy, one, it may cause some issues of ineligibility for renewal and or price to go up significantly. So it is important that clients also understand each other's driving records before they just jump in and combine coverages, to understand what kind of repercussions may present themselves based on past driving history. And then after marriage, tends to come the phase of starting a family. And with that usually comes young children. Sometimes that can be pets. There's a wide variety of what starting a family means. And for this example, we're going to talk through again those younger children in households. So maybe both parents have to go back to work. They decide they want to have a nanny come into their home to start taking care of their child. There is a liability need that arises when you have someone working in your home full time. So we'll talk through, workers' compensation, which is what would pay that nanny if they got injured in the course of work. So maybe they were, doing a little cleanup while the baby was napping and they tripped and broke their arm and need to go to the hospital. That could fall into your client's responsibilities, since that nanny was in the course of work when the injury occurred. We also want to understand if maybe this house, before there was children, it was just husband and wife there, but now that we have kids, maybe we've turned into a home where everyone likes to hang out. So medical payments become really important. And medical payments are important on a homeowner's policy because they're no fault. So if a child gets injured or an adult gets injured, you don't have to be sued by your guest in order to help pay for those medical needs that may arise. So I do recommend, when there's young children on premise, or if like just to host in general, clients should carry no less than 5,000 in medical payments. And ideally, and with some carriers, you can get up to 50,000 in medical payments, and it's like $5 a year. So again, it's a no fault coverage. It provides a lot of value to your clients as they're, starting a family or entertaining as an established family. And again, can just help make their guest whole again without a huge lawsuit coming into play. A very cheap coverage, but adds a lot of benefit. And then again, those lifestyle considerations. So we mentioned that trust and the importance of, if you do help your clients deed or redeed their properties into the name of a trust or LLC, helping them also communicate that to their insurance professional so the documents align. We also have, adding pets to the home and understanding, maybe they were with Progressive when they first bought their home and there was an animal liability exclusion in that Progressive policy, which on the day of purchase didn't matter because there were no animals in household. But now, as they've started their family, they've added a cute little mutt to the home, and maybe there's some exclusions or limitations around animal liability that they now need to understand and potentially fill in that gap based on adding that pet to their home. And then lastly, maybe as they start to grow their family, they decide to make changes to their home. So maybe they decide to finish their basement. And once we finish a basement, that brings on some additional considerations such as water sewer backup. What happens when water comes into the home through those drains and damages all the finishes? Water backup's what's going to help your clients pay to get that water out, replace the property and the finishes that were damaged. So again, as you've noticed, even just getting married and starting those first phases of life comes with a lot of choices, and all of those choices somehow potentially have an implication on the personal insurance needs for these individuals. And the next milestone is children of driving age. And again, this ranges across the country and there's a lot of different considerations that come in, but these are just a few of the big ones that I always used to talk to clients about when it was brought up that they may have children coming of that age or they were calling to actually add them as a driver. So when we go to add young drivers, one, it's usually expensive. So adding a 16-year-old, regardless if it's male or female, is going to add cost to the policy. But what really drives cost is when there's a vehicle added with that young driver. And so I would always get asked, well, what's the cheapest car for me to add to my policy for my kid? Because I want them to have a car, but I also don't want to be paying buku bucks to insurance companies for that. And the real answer is there's a pendulum in personal insurance. And when you have a brand new car, there's a lot of discounts that can be provided for that vehicle safety. Insurance companies have a higher likelihood of being able to repair a newer car instead of having to total it out due to part shortages or whatever that may be. And or buying a really old car that you can pay cash for. Buying a car that is 10 years old is actually one of the most expensive vehicles to insure when you have a loan on that car and need to carry full coverage. And the reason for that 10-year-old car being one of the more expensive vehicles to insure, regardless of year, make, and model, is because from an insurance perspective, that vehicle's has a higher likelihood of being a total loss at time of a claim. And so obviously the insurance companies are preparing to pay more out. It also is harder to repair those cars. So again, when it comes to what vehicles should my clients consider for their younger drivers, I personally recommend a newer vehicle. Obviously nothing with like a sports package or, Hemi, any of that craziness. But a new safe vehicle, and or again that older vehicle that they can pay cash for, that they can carry liability on. And so if there is an accident, one, that kid won't just get a new car from the insurance company. They'll have to figure out a way to handle that. But it does give a little more flexibility in what the overall cost is going to look like. I do recommend that your clients talk with their insurance professionals before buying a car for a child. It is very easy for them to quote. They might scuff a little bit because it does take some time, but it's not hard. And it can really help your clients be prepared before they go to the dealership or before they show up to their child's 16th birthday with a new car, that they understand what those financial burdens and another word may be. It happened a lot to me where someone would go buy a car for their kid, they call to add it, and I'd be like, okay, that's $3,600 a year now for young Johnny and that new 2000, 15 Nissan. So again, these are things that could really disrupt not only the planning you're doing, but just where your clients and how your clients want to support their children's driving habits. And so I think having a conversation with their professional is always a good choice when it comes to one, adding a young driver and adding them with or without a vehicle specifically designated to that young driver. Um, then we have discounts. So when it comes to discounts for children, one, there's student discounts, and those can be for good grades. Those can also be for if they went through a driving course. Or typically, these discounts are only available till the age of 25. So we do understand that there's, students that are over that age, but those discounts typically do not apply once a child's over the age of 25. It's just an industry thing. And then we have telematics. And telematics is something I was a big supporter of when it came to helping clients have more individualized pricing in their auto, especially with those young drivers. Telematics does track driving. It typically tracks how fast one drives, how hard they brake, their time of driving, and sometimes how quickly they accelerate. So, variety of different things, but it does help young drivers become better drivers. They get a cool little map a lot of times. It shows them where they're having these issues. There's a point system associated with it. And a lot of times, it helps children want to be better drivers where they see they can earn points in different ways. But it also allows for that individualized pricing. There's some telematic programs out there that offer 20 to 35% savings every year on a vehicle. So again, with those young drivers, if your client calls you and says, "Hey, it's going to be $3,600, any idea what we can do?" Recommending that they talk with their insurance agent about a telematics discount for that young driver may help offset that premium quite a bit. And again, teach that young driver how to be a better driver while also saving money. We then have liability limits. So, typically, when you have a young driver on the car, it is recommended to increase your liability limits if they're not already at least 100,000 per person, 300,000 per accident. I always recommended my clients have 250,000 per person, 500,000 per accident, with no less than 100,000 in property damage. But in some states, that's not the case. So, specifically North Carolina, they do seed their autos in certain situations. So North Carolina, when you're seated, that can be because you're a really good driver or because you're a really bad driver. It's a pool and it helps offset the cost, but it does limit the amount of liability one may purchase. So I had a lot of situations where I maybe had a family that was about to add a 16-year-old driver, or they just added a 16-year-old driver to their state farm policy and they wanted to shop it with me, and we'd go to market and I could only get 100,000 in liability for them, 300,000 per accident, and their state farm policy had more. And that's because the young driver caused that household to now be seated, where State Farm, since they were established customer, was able to keep them out of the seeding pool in North Carolina. So again, as young drivers start to become part of the conversation, being careful on having your clients shop the market may be a better choice. And again, working with their current agent, understanding what limitations are out there before just jumping ship and going to another provider that might not have certain limits grandfathered in to those packages based on the established household versus where it's changing. So I know that was just a lot of jargon right there, so I apologize. But really, the idea behind liability in children is you don't know how bad of a car accident they're going to cause. You don't know if they're going to hit one car, if they're going to hit that school bus leaving the high school. It's just really unknown. And making sure that if your client's children do cause a bad car accident, that you can make those other parties whole again without having to dip in to the assets that you all are managing. And then lastly, we have accidents and tickets. So, when it comes to accidents and tickets in young drivers, they really impact your rate. Like if a 35-year-old has an accident, you'll see some, impact on a surcharge. But if a 16-year-old driver has an accident, you're really going to see an impact. And if your client has just moved to a carrier and they have an accident within that first year, you might even see non-renewals come from that because of now the risk of that client with the auto accident. So, when it comes to accidents, I do recommend that your clients talk with their insurance professionals before they just call that 1-800 number. And the reason I say that is, and honestly, they should probably talk to you all as well because you do understand their finances. But if their 16-year-old is in the high school parking lot and, bumps into another car's bumper while they're waiting to leave school, I'm not sure I would run to my insurance company to file that claim. I would recommend working with that individual outside of insurance to repair their bumper. Usually, if it's, 1,000, $2,000, that way we don't have a claim go on our record that's now following that child for 3 to 6 years and seeing an impact from a rate perspective, as well as if they bump someone in the parking lot. That might mean they're a distracted driver and they could have a larger accident in the future that, again, maybe does some true medical damage to somebody. And that's where we really need this auto insurance to come into place. So, when again, it's young drivers, understanding the give and take in those accidents is important. And same with tickets. I know this is state specific. So, for myself, I live in Missouri. And if I were to get a speeding ticket, there is the ability for us to move it by working with an attorney to a non moving violation, which removes the points. And from an insurance perspective, as long as a ticket doesn't have points, it doesn't typically affect my rate. So, in states where your clients can work with attorneys on speeding tickets to have them move to non-moving violations, it does have an impact on the insurance long term. Because again, speeding tickets usually are chargeable for 3 to 5 years. If it's a serious offense, so going over 20 miles per hour or something like a DWI, those can be chargeable for 7 to 10 years. So again, accidents and tickets with young drivers can have a large impact. An example I'll give here is I actually had a client who was in the high net worth space. He had a few collector cars and he did let his son drive one of his Porsche 911s. Unfortunately, his son had been in a car accident a few years prior. He then had his license suspended due to parking tickets. We got that all cleared up. And then about 3 months later, wrapped the Porsche around a tree. There was about $45,000 worth of damage. But based on that child's driving record, and some other factors, the dad decided not to go through insurance to get the Porsche fixed. He paid for it out of pocket because, in all reality, if his son would have had another accident, they probably would have become uninsurable from the liability perspective that he needed. And so, from his standpoint, he would rather fix the car out of his own pocket, be able to stay insurable and get the right limits, such as the $5 million umbrella that he needed, the 250, 500 auto limits that he wanted. And again, that's not the situation for everyone, but it does show. And again, this is where, as advisors, you guys have a really unique perspective of your clients to say, hey, this client actually does have that type of money that they can spend in order to keep their choices open for them. Others may say, hey, there's no way you have $45,000 to repair your car. Go through insurance, and then we'll have to figure out maybe not having enough liability. Maybe, our son isn't going to be able to drive the cars anymore, and we'll have to do something in house. But helping clients and allowing clients to know they have a choice before just going to insurance and being kind of stuck into a situation that may not be desirable is something that, again, a good insurance professional can help you work with your client through to make sure that, again, these young drivers don't totally derail their insurability and the protection for all the assets in which you guys manage. So next is our children are finally driving and they're going away to school. So when children are away at school, we tend to see that homeowners coverage can extend to their dorm room. So it would cover their personal property while they're there. It would cover if, someone got injured or they damaged the dorm room in some way. But the downside to extending liability or coverage from your client's homeowners policy is, one, the deductible will apply. So if your clients have a nice home, maybe they have a $5,000 homeowners deductible and their clients or their child's laptop gets stolen at school, you're most likely not going to be able to file a claim under the homeowners for that laptop because it's under that $5,000 deductible. Also, if you did file that claim, it's going to be chargeable for 3 to 5 years on a homeowner's policy. And in all reality, you really want to save your client's homeowner's claims for their home and for those larger catastrophic type losses. So, what I recommend is for clients whose students go away to school, purchasing a renter's policy. It's very cheap. It's usually about 100, maybe $200 a year, depending on if you want to add any type of endorsements or riders for things like electronics or if they take jewelry with them. But by having the children get a renter's policy, one, it takes the loss history out of the parents and puts it kind of on the child. The renter's deductibles tend to be a lot lower. You could choose a 250 or even $500 deductible. And then again, if there is a loss, the client has no qualms about filing the claim under renters because it's not going to affect their homeowners. they're going to pay a low deductible of $250 and they will be able to get that $2,000 laptop replaced. And again, without too many repercussions from a larger scale. So I do think for home coverages, and liability as well within that renters is extremely important. And when it comes to college kids, if they rent a unit outside of campus, sometimes those different organizations will have, a pre-built renters program to use, and they'll only include 100,000 in liability. I highly recommend for college students a minimum of 300,000, if possible 500,000 in liability. Just like medical payments, it's super cheap. It's like $15-20 a year to go from 100,000 to 500,000. And again, if they have a few too many people into their apartment, someone gets severely injured, a person drinks too much, and it was found that this individual is the one that provided the liquor. There's just so much that can happen on a college campus that purchasing a little more liability for 10 or $15 more a year, in my opinion, was a no-brainer when I worked with clients. We then have autos. So again, not all kids take cars to college, but and for those kids that don't take cars to college, there are discounts. Specifically, it's a discount for a student over 100 miles away without a car, and it does provide significant savings because basically what it does is it rates that child as an occasional driver, knowing they're only home on holidays and different things of that sort, versus a full-time driver. So it is important if you have clients whose students go over 100 miles away without a car that they're talking to their insurance professionals to get that nice savings. Because we don't want to remove those drivers while they're at school. I one time had a client call me and was like, "Hi, Johnny's going away to college. He's going to be, 250 miles away. Let's just remove him for the auto policy and we'll add him when he gets back." The downside to that is if we remove Johnny, he loses all that uninsured coverage or uninsured and underinsured liability coverage that he gets by being a household member. So again, one day while Johnny's walking to class on campus, another student unfortunately, looks down and before they know it, they've hit Johnny walking down the sidewalk. If Johnny wasn't on parents' auto policy, he may not have much coverage outside of what that other party has. But by him being a listed driver on the parent's auto, he could have that uninsured motorist or underinsured motorist extended to him in those situations. So again, keeping kids on the policy and applying the right discounts is the best way to go about the vehicles while students are away at school. Also, again, back to that auto liability, making sure that that vehicle doesn't just have state minimum coverage, that there is, a little more cushion there for those larger losses, because most likely there's going to be a few kids in the car a lot of the time while they're driving. It's not just your child driving themselves around. And then lastly, who has access to the keys? So I actually learned this through a personal experience. My sisters went to a university and they were part of a sorority. And on Friday nights, they would have assigned drivers for DDs, which was a great idea. However, some students that were designated DDs didn't actually have their own cars and they would have to borrow other individuals' cars in order to participate in the DD program. And so, one night, my sister, I was out there with her and I saw another child driving my parents' car, and at the moment, it didn't really click. But as I started to learn more about insurance, it really resonated in that, what happens if that person causes a bad accident? And, 10 years ago, permissive use was just a no brainer on, hey, if you toss someone your keys, they're going to have whatever coverage is on your auto policy. You're good to go. That's not the case in today's world. There are now different limits for permissive users in certain states by certain carriers. I've seen it a few times with farmers where again they have your core limits on if you're a listed driver, these are the liability limits you get. But if you're not a listed driver and you're just a permissive user, you're actually going to get drop down limits of potentially state minimum. So again, understanding who has these keys, how that affects the client's overall protection is another big piece when going away to school. And then lastly is umbrella. So just again, appropriate liability limits. We've talked about uninsured motorist and that aspect, but then we have uninsured liability. And again, this would be for, maybe a child that is away, they're at a friend's house, they have a day party, and your client's child gets severely injured. Maybe while swimming. And if they go to sue that individual whose house it was or the sorority or whatever that case may be, and they don't have enough liability, your client can purchase $1 million plus an uninsured liability to pay out to their child for those injuries that were caused on someone else's premise. So, again, not everyone needs this, but there are situations where at least having this knowledge for your certain clients can help add value when talking and helping them determine what exposures they may be facing as their kids prepare to leave for school. And then we have our pre-retirees. So, at this phase in life, there's family dynamics are changing. We may have kids start to move out. We may start to see new hobbies. Maybe we have parents moving into the home. A lot can happen, and those family dynamics do change. Like we've discussed, the policy limits and the policy coverages that are in place, specifically those kids moving out. Once they are out of college and no longer living in household, they should not be a listed driver on the auto, and they really should have their own renters. And the parents are kind of done from a liability perspective and what they need to be concerned about from can an attorney come after their assets based on their adult child's action. So where that does change is if mom and dad co-sign on that rental for Neil in Chicago. Now we may have again that family is still or the parents are still tied to Neil because they've co-signed that lease, extending their personal liability. So again, supporting and understanding what those are is another piece to this puzzle. But when we're talking about the pre-retirees, we also talk about upgrading or downsizing. So maybe now that children are out, their parents aren't going to be moving in. They're going to do a huge kitchen renovation. And once we start to talk about rehabs, there's a lot that comes into play. So, who's going to do the work? Are the clients going to remain in the home? Is there any type of structural changes that are happening? Depending on how clients answer those, will determine if their current homeowner's policy will suffice or if they maybe need to consider something like a builder's risk or just an endorsement onto their home policy. We also have the downsizing side. So maybe they no longer want to live in the 3 bedroom, 2 bath house and they just want to move to a condo. Um, let's say this client found the condo really quickly. So they move into their new home and their current home, they're just going to fix up slowly and they'll put it on the market in a few months once they're ready. While that home is sitting vacant and kind of under that repair phase, it's important to understand exposures and limitations within policies. We do see, if a home is vacant for more than 6 months, there being limitations. Sometimes that can be as short as 60 days. So again, as they transition from one home to another, making sure that both properties are covered properly and that insurance agent understands who's living where can help avoid any gaps in coverage while that downsize occurs. We also have our umbrella policy. So we talk about net worth and what's the right umbrella limit. And usually for younger families, I would say your 401k is very well protected by the government. We don't always need to consider it in your umbrella limit. That is not the same answer for a pre-retiree, and that's because once the individual becomes a true retiree or starts to withdraw from their 401k, that money can now be seen as creditor accessible. So again, pre-retirees should start to consider their 401k and their retirement benefits as their net worth and making sure that that umbrella limit does encompass those different things. And then we have our lifestyle choices. So again, maybe they didn't put their home in the name of a trust when they were getting married, and now they're getting documents ready for whatever reasons are, and they're just doing that now. We always have those type of changes. We'll talk through, maybe they're going to be adding some enhancements in those upgrades. So whether that's cyber exposures that we want to talk about, maybe they're going to be adding in those Alexas. So a lot of different things happen in this pre-retiree stage that again working, and I'll show you in our demo after this how our system can help you catch some of these pre-retiree life choices. And then lastly, we have our seniors. And kind of like the young drivers, we have some liability concerns here that we need to consider. One, just like with the young drivers in North Carolina, some seniors may run into the limitation and ability to buy up the proper limits, whether that's due to them being seated, or other issues within the state they reside. So I do think it's important for seniors to carry those same limits that I've recommended for young drivers of, the 250,000 per person, 500,000 per accident when they have the ability, but obviously no less than 100,000 per person, 300,000 per accident. Um, and really when it comes to liability limits, one of the corresponding things is accidents. So when a senior driver has an accident, it really not only impacts their rate, but it impacts their eligibility. And I one time had a client, or it was a prospect actually, that came to me. His net worth was a little over 10 million. He lived in Florida. He was 73 years old, maybe 75. But most wonderful, kind gentleman I'd ever spoken to. And he had unfortunately had a boating accident that summer. His watercraft was insured with Progressive, and he went ahead and filed that claim with Progressive. It was just a minor damage to his boat, I think like $5,000. But he had started to work with a new advisor, which is how I got in touch with him. And at the time of the boat accident, he only had a $5 million umbrella. And after working with his new advisor, had wanted to increase it to a 10 million. Well, when we started to go to market for this individual, we actually not only could not get him a $10 million umbrella, but we had a really hard time even finding a $5 million umbrella that would write him. And that was because of that recent boating accident. So not only was he seeing rate on his watercraft policy because of that accident, he was actually seeing limitations in the options he had from an umbrella standpoint because of that. And now at a time where he has potentially the most assets he's ever had, he has them unprotected because of a choice he made in the idea of, well, that's what insurance is for. I should file a claim because that's why I have it. And had he really had a professional talk with him through that. Again, even as an advisor, you may be saying, hey, well, yes, that is why you have insurance. You have, $5,000 you can pay for out of pocket. You should probably do that versus going through insurance. Would have saved this prospect a lot of time, a lot of headache, and given him the peace of mind that we could have potentially purchased the right umbrella policy for him if this accident wasn't on his record. So again, accidents not only affect the line item that they occur on, so whether that's the auto policy, watercraft, but it can affect other lines of business. I've also had it where an older driver, this one was in their 60s, wanted to go out and buy a sports car. And they had had a speeding ticket within the last 3 years, and we couldn't find anyone that would write his new sports car. And I don't know if you all have ever had the experience, but telling someone that they can't have something after they've worked really hard to obtain it is probably the worst situation to be in. And so, again, guiding your clients to understand how certain decisions, such as those speeding tickets, can potentially have repercussions in the future on being able to buy that new car that goes even faster, is where you guys could add additional value that your clients may not be expecting. And then we'll kind of, continue on with that market option. So not only does it limit market options, but clients do get non-renewed. And I had to go through the experience of watching my dad work with his mom to take her keys away. And that was heartbreaking. And for her it was time because she wasn't great at seeing. It just for everyone's safety was the best. But there is nothing worse than having to take your parents' keys away because they can't get insurance. And so when I talk about renewability, there are programs out there. AARP, Hartford is their actual name, but they have an AARP program for older drivers, and they do grandfather renewability, meaning even if seniors start to get into accidents, the Hartford's going to offer them a renewal. Now, that rate may be super expensive, but it at least gives the individual the ability to stay independent and not have an insurance, industry tell them that they can no longer drive because nobody wants to do business with them. So again, it's a sensitive subject. It does start to come up more and more as people hit the age of 70. And that's because a lot of insurance companies don't like to take on new business for individuals over 70, 75 sometimes. And then if you add an accident in there, it just really makes them an undesirable client, unfortunately, for a lot of insurance markets. So this is a place where you can add a lot of value, especially to clients you may have been working with for a while, reminding them that, hey, if you are in an accident, let's touch base, see kind of if insurance is the right decision before you just call that 1-800 number, might be a blessing in disguise in the long run. And then we do see a lot of times, when people are in retirement phase, that they have more time on their hands. Maybe they want to start hosting events at their home. So we have some special events coverage that we'll talk through in the demo. But maybe their health starts to decline, and now they have healthcare workers in their home with them. This is another large exposure, just like we talked about with nannies being on premise. Once your older clients have healthcare workers in their home, there's the ability or there's the possibility that they may be seen as employers to those healthcare workers. A lot of times, even if these healthcare workers are hired through a company, they're still 1099 employees, which means they don't have workers' comp coverage and they may not have employment practices liability coverage. And that would pay for things like sexual harassment, discrimination, wrongful termination. So again, with this aging generation, it is important to understand if they have help, what type of insurance that help carries, and if they don't carry any coverage, what type of coverage your client should be considering to help protect themselves in case a claim does arise. They have protection in place. Not only do pay out for those damages, but also pay for the defense coverage that it will take in order to defend them. So before I jump in to the demo and kind of highlight where our tool will help you all catch some of these milestones in your client's life, do we have any questions?
Yeah, we have a couple questions actually.
We do.
So the first one is, can you please explain whether it is worth paying for the extra insurance when renting a car for vacation?
Great question. So I think it depends on how long, you're going to be renting. I personally do think there is a benefit to buying the rental car company's insurance. And those reasons are one, there's usually not a deductible. So unlike your auto insurance that may have a $500 or $1,000 deductible, if you buy the rental car companies, if you do damage their car, you don't pay the deductible. So that's savings there. It also doesn't go on your clue report or on your auto insurance report because you're not filing it through your auto company. So it might help on just future insurability. And then there's two kind of caveats to when you extend your personal insurance to the rental cars. One of them is diminished value. So if you are in an accident in a rental car and maybe they were going to sell it in 2 weeks, they may say, well, hey, now this car has an accident on it, so it's only worth $10,000 instead of the 12,000 it was before the accident. You could be on the hook for that $2,000 in diminished value. And I actually had this happen to a client. They had rented a car. They were in an accident, and it was the week before Easter. And so the car now was no longer available for that Easter weekend, and the rental car company tried to charge them for loss of use because they weren't able to rent that car out for that time. So by buying the rental car coverage, you jump all of those issues. You don't pay a deductible. It's most likely not going to go on your report. The diminished value isn't a thing, and the loss of use is not a thing. So there is some nice caveats. And if this question's come up, I don't know how credit cards compare to that. So please don't ask if a credit card covers a rental car better than an auto. But there are benefits in paying that rental car coverage insurance over just extending your personal. Another example, real quick, is I had a client that went camping with a rental car and they were going off-roading, and the rental car company did not approve that. So also understanding like what you're going to be doing with that vehicle and what limitations may be in that rental car are also important before deciding what insurance you may or may not want to use.
Perfect. The next question is, if a couple is having a home renovated and needs to move out for a few months, what needs to be communicated to the home insurance company before, during, and after the renovation?
Great question. And we actually do have this in our review now. So I will make sure to show that in the demo. But one, when clients are starting to discuss a renovation, they should talk to their insurance agent. Knowing that a client is going to be out of the home for a few weeks or a few months is a trigger that the insurance company needs to know because that home's going to be vacant. And a standard homeowner's policy is not going to like that. And most likely, if they are moving out, it is a substantial type renovation where a builder's risk policy may also need to be put in place. So you would still keep the standard homeowner's policy in some situations to cover like personal liability and personal property, but then you may also add in either a builder's risk endorsement, or it's also known as a course of construction endorsement on the high net worth side, that will include a surcharge because when work is going on, there's a higher likelihood of a claim occurring. So again, just depending on the carrier clients are with, some may add a course of construction surcharge, some may require them to go onto their own policy. But again, talking with insurance agents well before the project starts is key. And the last piece that our system points out when it comes to renovations is the contractors that they use, and making sure one, those contractors have their own general liability and workers' comp. But lastly, that they're not signing a waiver of subrogation. And that is something that the personal insurance market or personal homeowners market specifically really has an issue with. And a lot of contractors don't even understand what a waiver of subrogation is, or that it's part of their contract and they're happy to remove it. But if that waiver of subrogation is not caught before a loss occurs, there can be a lot of issues, a lot of finger pointing. And a waiver of subrogation is basically stating if a loss can be covered by the homeowner's policy, then the contractor is not responsible for it. Example would be
Mm.
if a contractor is on premise, it's the end of the day, maybe, oh, I actually have a real life story. We had a client who had new mulch laid. They had all new lighting put on the outside of their home. And when the mulch company came, they covered all of the lights with mulch. And actually, that mulch caught fire, which then caught the windows on fire, which then caught a decent part of the house on fire. And had they had a waiver of subrogation signed, my client's homeowner's policy would have been on the hook for that because fire is a covered peril by the home policy. Since they did not have a waiver of subrogation signed, the contractor and their insurance had to cover it
Mhm.
because it was their negligence. So that waiver of subrogation basically changes who's responsible for covering what. And again, if your clients are the ones responsible, that means they're paying their deductible. That means they're going to see a surcharge for 3 to 5 years, even when it was the negligence of their contractor. So these are little minute things, but one, our system does point them out. But two, when talking with an insurance professional, ahead of time, you can usually catch before, hey, I'm moving out tomorrow. We're starting renovations. Here's everything going on. And then everyone's scrambling. So I do recommend as soon as you and your clients are aware, looping in their insurance professional to start that conversation.
Perfect. We could do one more and then we can go with the demo and then come back to the questions.
Perfect.
Do you recommend putting a car in the child's when they reach age 18 to limit liability?
So I'm not an attorney. I have to be very clear when I say that, but I do. I come from a family of attorneys, so I have heard a lot of kitchen table talk, and I do think it's helpful when the vehicle is titled to the child, and that's primarily for negligent entrustment. If the title stays in the name of the parents, and maybe that child, even at 18, has had a history of drinking and driving, and the parents still allow them to drive the car, they might get brought into a lawsuit and say, well, you knew he did this and you still provided him a vehicle and now he killed someone. Whereas if the car is titled to his name, the parents don't really have any tie to that. And if there is a significant loss, they're just going after those child's assets at that time. Again, I'm not an
Okay.
attorney, so don't quote me. Okay. And now I'll run into the demo real quick. And a lot of you, I hope, are familiar with our standard declaration kind of analysis where you just go here, you click, you upload the deck pages, and then we give you a great summary based on the key figures and the information we found within the documents. A lot of what I talked about today was around lifestyle, though, and how you're going to generate those types of insights for your clients is within that home icon and then within our lifestyle section. So again, we talked about renovations planned in the next 10 months. We talked about a home being deeded to a trust or LLC. We have some children away at school. We talked about animals. So as you can see, a lot of what we talked about here, we now have different insights by you interacting with this section. So we'll just start here with those. And by doing that, you will now notice we have a few renovations. So let me just do this one here real quick. But we have our contractor's consideration, like I mentioned. We have that builder's risk policy, so depending on the size, and then we talk about coverage limitations. So again, if you didn't know what to show your client, you could show them all three, or maybe that they're definitely going to need a builder's risk, so you're going to hide this. It gives you flexibility, but we broke it up into three insights because these are three major things to think about when your clients go through renovations. We also talked about, that child away at school and why a renter's policy makes sense for those students. We also talked about animals on premise. So, this family now has an animal on premise. We can show that here, and maybe they need to talk to their agent. We give some insights around the trust and LLCs. So, as you can see, we are starting to help you all understand more outside of what's their dwelling limit and what's their liability limit. It's what it's doing day in and day out that affects their needs that they need to be having conversations with an insurance professionals about. Same thing for the auto. We have the child driver on policy. We can now select if they're, again, this 100 miles over. So we know, or our client now knows to talk to their insurance professional about that. We can talk about, maybe senior in that senior category, they've started to liquidate their estate and they gifted that car to their grandson. That's a big issue that we may want to bring up in understanding what exposures come there. Again, that employee. So really just helping you all have the right conversations. And based on what we've selected, you will now notice that we have additional insights specific to those. And again, for our home healthcare workers, it's not uncommon for them to drive our clients' vehicles to get them to and from work. And this helps explain that as well. So, a consideration if they're using their own vehicle or if they're using a client vehicle. And then lastly, we have our umbrella considerations. So again, this can be if they participate in that non-for-profit, full-time employee, maybe they have a net worth over 5 million. And when they have that net worth over 5 million is where we will see that insight for right here. And this is where we also talk about this third party liability. So, like I mentioned, for those kids away at school, if they are injured on someone else's premise, having third party liability can be really beneficial. This is only available with most carriers once your client has a $5 million umbrella or higher. So, again, just helping educate around that. Then we also have notes for you to share on what this may mean. So maybe your clients don't currently have it, but you want them to talk to their insurance professional. You can add that by clicking this to the agent letter for them now to discuss. And if, well, these all would show on the report since they're currently not hidden. But if I didn't want these to show on the report, I could simply click these eyes and now these notes will no longer appear. I apologize. The mail is being delivered, and the dogs are barking. But that's just a high level demo. And again, really what I wanted to help illustrate was a lot of the milestones that your clients are going through are not going to be picked up on the declaration pages. It is something that you all are in a unique seat to know and understand and interact with our system to just get a more customized report based on how they live day in and day out. But any last minute questions before we jump off?
Yeah, I have a couple. And any questions that we don't get to, we'll send within the recap email. So I just wanted to let everyone know. But one of the questions are, if a car windshield is damaged by a rock in the road, the windshield needs to be replaced for $1,000 and the client has a $250 deductible. Is it better to claim or not claim this incident? How will it affect future premiums?
Yeah, so in that situation, when it comes to glass claims, I think filing one every like 3 to 5 years is not a big deal. It's fine. It's when there becomes a frequency issue that underwriters get a little paranoid and or won't write the business. So you all know your client's situation from a financial standpoint better than probably they do. So if they have it in their financial means to pay out of pocket, 100% pay that out of pocket. But if they are living paycheck to paycheck and $800 really could, disrupt their life, filing a claim on insurance is okay, but also with the caveat of hey, we're going to file this one, but know if another rock hits your windshield, you're going to be paying for that out of pocket. And again, just kind of coaching them a little bit. In Missouri, we can't pass like a safeties inspection if our windshield's cracked, like within the driver view. So I'd always recommend my clients wait until right before that safety inspection to renew their plates if they wanted to file the insurance claim, just so it wasn't a frequency type thing. But that really is a client specific type issue. Again, for high net worth clients, I don't think they should use full glass on the auto just because it can disrupt other things based on how frequently they may use it. But again, if it's once every 3 to 5 years, not a big deal. And that's kind of what it's there for.
Okay. I have another question that says, what if a senior does not drive anymore? They live in a retirement community. Do they still need an umbrella?
So potentially, and you can definitely get umbrella coverage that just extends over their homeowners, but depending on like the community they live in. So like my grandfather lived in a community, but all the homes were connected and he had a kitchen and he was known to leave his stove on. And so for him, having an umbrella was important because if he left that stove on and burnt down multiple units, he would be held responsible for that. And the umbrella coverage would help pay out all that damage. So I do think having an umbrella policy, even when there's no auto in place, does make a lot of sense.
Okay. The next question is the uninsured liability reference separate from slash in addition to the umbrella policy, or is that synonymous?
Great question. So it's you get it the coverage in two places. So one is on an auto policy, and then you can buy additional protection on umbrellas. So not every company offers the additional uninsured motorist on the umbrella, but there are companies that do offer that. So the first layer is always going to be on the auto policy, and then if the auto policy is not enough, maybe the whole family's in the car and there's significant damage, or again, an individual is
Mm.
walking down the street and severely hurt, there is umbrella availability to purchase more, usually around $1 million and up.
All right. We can do one more question before we wrap up. Does the comment about creditors assessing 401ks once in distribution also apply to IRAs?
Great question. I'm not 100% positive. And even for the 401ks, that does have some state specific type things. So I would definitely check in your state specifically, but I'm not sure. But Tracy, if you'll add that as a follow up question,
Yeah,
I
for
can
sure.
definitely get the answer to that to send
Yeah,
out
we'll
with
do.
everything else.
Sounds great. And with that, we are at 3 o'clock. Thank you so much, Megan. And
Of course.
that was amazing. And just a recap, we will send out the slides and the recording as well. So make sure to keep an eye out for that, along with the questions that we didn't get to today. And thank you, everybody, for attending, and we will see you soon.
Have a
Bye,
great
everyone.
day.